Almost all investors who invest in mutual funds are unknowingly investing in a way that's actually depleting their returns. Yes, you heard that right, and you might be doing it too. You're picking funds based on star ratings, random blogs, or tips from colleagues, but the result, a scattered mutual fund portfolio that's not built to support your goals. Here's the truth, it's not your fault. Nobody taught us how to build mutual fund portfolios that actually perform. In this video, I'm going to show you exactly how I select funds for my clients and how you can do the same with clarity and structure. And stay till the end because I have a special announcement for you. Let's begin with something that most people do not realize. Your portfolio could be underperforming the market and you wouldn't even know it. Here's one of the most common mistakes that I see. People allocate multiple funds to one single goal, thinking that more the funds, more the diversification. But that's not how it works. Instead, break down your goals into three clear buckets: short term, mid term, and long term. Then choose funds that suit each time frame. To make it simple, refer to this table below. When you follow this grid, you're not just investing, you're planning. You're giving each rupee a purpose. And suddenly, your investments start working for your life goals instead of stressing you out. Now, here's something most investors miss. Who is managing your money? Choosing a fund without checking the fund houses is like buying medicine without checking the brand. Not all fund houses are created equal. Stick to those with a solid reputation, experienced fund managers, and a long history of managing money well across different market cycles. If the foundation is strong, your portfolio can handle volatility better. So don't just chase returns, check who is delivering it. Now let me show you how I go about selecting mutual funds step by step. I use this tool called Engine for analysis. The very first thing I do is I filter out most of the credible fund houses. Over time, I have shortlisted 21 fund houses that I truly trust based on consistent performance and management quality. Next, I choose a fund category that I want to evaluate. So for the sake of this video, let's go ahead with flexi-cap funds. After that, I apply a filter to only include those funds with minimum 3 years of track record. I personally believe that funds need at least 3 years of data to understand how it has performed across market cycles. Finally, I have all the funds that I need on my compare list. Here's another filter that I personally use that very few people talk about. I avoid funds with extremely large AUM. You might think bigger the better, right? But in mutual funds, a huge AUM can actually become a problem, especially in mid-cap funds and small-cap funds. Here's why. Because deploying larger amounts of money into smaller stocks becomes inefficient. The fund manager struggles to find quality opportunities and the fund can become sluggish. It's like trying to turn a truck in a narrow alley. It takes time and it's not agile. So I prefer funds with manageable AUM sizes where the fund manager still has flexibility, agility, and make meaningful positions and still create alpha. After you have removed the funds with larger AUM, let's move on to the next step. Let's quickly talk about two important ratios, up capture ratio and down capture ratio. Imagine the stock market is like a roller coaster. It goes up and down. Up capture ratio is how much a mutual fund rides up when the market is climbing. So if the market goes up 10%, your fund goes up 12%, that means it has a higher up capture ratio. That's a good sign. Down capture ratio is completely opposite. It tells you how much your fund is going to fall when the market is down. So if the market drops about 10% but your fund goes down 5%, that means that you have a low down capture ratio, which is great because that means that your fund protects you against big losses during bad times. What you want is a fund that has a high up capture ratio so you do not miss out when the markets rise, and a low down capture ratio so you do not lose much when the markets fall. Knowing these two numbers will help you pick funds that grow well but don't scare you with big crashes. Now let's see here. Invesco and Motilal Oswal have favorable up capture and down capture ratios, so let's just shortlist these. Alright, now let's quickly talk about something that can really help you judge how mutual fund is performing: rolling returns, especially over a period of 520 days. So why do I bother checking rolling returns? because markets move up and down all the time. If you just look at one fixed time frame, the fund might look amazing just because you picked out a lucky start date and an end date. Or it could look terrible just because you accidentally picked out a bad patch. Rolling returns will help you identify the fund's performance across multiple periods, not just one specific time frame. It gives you a clear and more honest picture of the consistency. Now, I won't go too deep into the technicals, but here's what I look for. I want funds that have shown positive returns 100% of the times across these rolling periods. I prefer funds with a narrow range, no wild swings. Basically, I avoid funds that have extreme highs and extreme lows. That's just unnecessary risk. When I look at rolling returns, I'm looking for steady performance, not just one hit return. So because of this, it helps me build a very steady growth portfolio. Motilal Oswal, Tata and Bandhan look favorable over here. So let's shortlist these. And finally, we really want funds that show consistently higher returns, not just occasional burst of performance. It's not enough for a fund to do well in a while. Anyone can get lucky in a market cycle, but we are looking for funds that deliver above average returns again and again across different market phases and cycles. Bull runs, corrections, sideways movement, everything. And here I feel Quant and Motilal Oswal top the list. Before we jump into the final deep dive, make sure to check the risk to reward ratio for each and every fund within the same category. This helps you understand if a fund is giving enough of return for the risk it's actually taking compared to its peers. Sometimes the fund looks too good because it's taking too big of a risk, but you do not want that. You want a balanced risk to reward ratio. So finally, after all these steps, we have arrived to the shortlisted funds that pass all these tests. Now it's time to open each and every fund up and have a closer look. First, check if it has consistently outperformed the benchmark over different time frames, because beating the benchmark isn't just luck, it's actually skill. Next, take a look at the sector allocation. Is the fund too heavily invested in just one sector, or is it well diversified enough to handle market ups and downs? Also, check how much equity exposure is there in each and every fund. Is it overly invested in stocks, or does it have good balance with debt? Within equity, what is the mix of small cap, mid cap and large cap stocks? This will tell you the risk levels and the growth potential. And of course, look into the fund manager's expertise. How long has he been managing the particular fund? What has been his track record? If you want to know more about the fund manager, go look at his interviews online. It will give you a better perspective about his investment philosophy. Finally, check the top 10 concentration of the stocks. If a fund is too concentrated in the top 10 holdings, the fund can be a lot more riskier. This deep dive is what will separate a good fund from a great one, and this is exactly how I pick funds for my clients, step by step, with data and discipline. Thank you so much for watching till the end. There's a lot of construction going on. Thank you for bearing with me. I know I have used some premium tools and softwares in this video to analyze the funds, but if you do not want to spend a huge chunk on these softwares, I have 3 powerful options depending on where you are in your investment journey. Option 1 for the DIY investors. If you're someone who wants to do it yourself, I have created a free checklist and framework that covers everything I spoke about today, from goal mapping to category selection to portfolio overlap, everything. And guess what? It uses free tools. You can download it using the link in the description. Option 2 for those who have portfolios lower than 20 lakhs or an SIP book of less than 50,000 per month. If you're an investor in this category, I have created a ready to invest mutual fund growth portfolio available exclusively on Signalz. You will also get monthly portfolio updates, access to 12 plus research reports, exclusive personal finance workshops, and 4 one-on-one meetings with me every year to ask me anything and stay on track. Option 3 for portfolios above 20 lakhs and SIP above 50,000 rupees per month. If you're in this category, I would recommend not jumping straight into the DIY approach. Here's why. The framework that I shared today is great for getting started, but for larger portfolios, there are deeper layers, like multiple model portfolios across strategies, fund combinations that aren't available in public tools, and advanced asset allocation techniques. That's why I would love to invite you for a free one on one meeting with me. The link is in the description. In this session, we will walk through how I can help you build a more robust portfolio, a high growth mutual fund portfolio for protection with clarity. No pressure, just real conversation.